58.5% of Digital Core REIT's distributable income this half comes from non-cash accounting entries, not rent collected from actual tenants. If you are drawing retirement income from this trust, that is the single most important number to understand today. The headline yield clears every test, but the balance sheet carrying it is failing two major thresholds at once. Management framed this reporting period as a core sustainable growth story. When you look strictly at the yield line, they have a point. The distribution passes the income tests comfortably, but a distribution can clear every single income test you own. It can still sit on top of a balance sheet that is failing you twice over, and that is exactly what is happening right here. The headline presentation and the actual forensic audit are telling us two very different things about the underlying health of the trust. If we want to protect our capital, we have to look past the marketing framing. We have to dig into the actual cash generation, and that is exactly the discipline this audit brings. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. The top line shows immediate pressure. Gross revenue came in at $88.57 million, which is down 0.4% year on year. Property expenses rose 5.4% to $44.9 million, driven by higher electricity overheads and colocation operating costs. That expense pressure pulled net property income down 5.7%. But the more concerning metric is the cash NPI, which fell even faster than the accounting NPI. Cash NPI dropped 7.1%, reflecting straight-line rent adjustments and leasing friction in the non-core colocation units. This tells us the actual cash being generated from the properties is shrinking. Let us trace how that flows down to the payout. Net profit attributable to unit holders fell 19.8% to $9.68 million. To hold the unit holder payout flat at 1.80 US cents per unit, management increased non-cash distribution adjustments by 20.7%, bringing them up to $13.65 million. Those adjustments now fund 58.5% of the total distributable income. That means more than half of what unit holders receive this half is coming from accounting entries, not actual rent collected from tenants. That is a structural vulnerability in the cash flow. Looking at the core metrics, the pressure points are obvious. Gross revenue is down 0.4%, property expenses are up 5.4%, net property income is down 5.7%, cash NPI is down 7.1%, net profit is down 19.8%. Every single one of these operational lines is failing the forensic threshold. The only passing grades are the final distributable income and the flat DPU of 1.80 US cents. And as we just established, those passing grades are being sustained by a 20.7% jump in distribution adjustments. A 10% shift in property operating costs equates to a $4.49 million swing in net property income. That would move the annualized DPU by roughly 0.35 US cents, or about 9.7% of the current payout. A macro trigger such as a 10% jump in North American grid power costs would compress NPI directly because colocation lease structures cannot fully pass through short-term utility spikes. For a Singaporean investor holding 100,000 units, a 9.7% distribution haircut works out to roughly 469 Singapore dollars a year in lost cash payouts. Management devoted several slides to AI demand trends and the unit buyback, but they said little about why distribution adjustments jumped 20.7% to $13.65 million. When non-cash accounting entries fund more than half of what you are paid, the payout is being insulated from operational drag, not generated by it. Entries like these can smooth a distribution for a period or two. Real tenants paying real rent are what actually funds it over years, not quarters. Silence on that dependency is exactly where the distribution risk sits. There is a concentration risk sitting underneath the cash flow. The top two customers, both hyperscale cloud providers, account for 45.7% of annualized rent between them. The largest single customer alone represents 30.3%. That is a concentrated tenant base, and it is not unusual for this type of asset. Hyperscale data center leases are built exactly this way with long-dated investment-grade tenants. But it means the cash flow quality rests on a small handful of counterparties staying in place and renewing on similar terms, not on a broad, diversified rent roll like a retail REIT. This is a soft flag to watch at every lease renewal. Management frames the half around 97.3% occupancy, positive rental reversions of 25%, and a massive sponsor pipeline. But the unit price tells a more cautious story. Digital Core REIT closed the period at $0.505 US. The reported net asset value is $0.79 US. That leaves the stock trading at a 36.1% discount to NAV. The market is clearly seeing the 97% occupancy, but it is choosing to price in the balance sheet risk sitting underneath the portfolio instead of the positive leasing metrics. We have a meaningful split in the valuation read. InvestingPro models place fair value at $0.56, which is a modest 9.8% mispricing. Meanwhile, 5 sell-side analysts have a consensus target of $0.72, suggesting a 43% upside. That gap is important. The conservative InvestingPro models are pricing in the current balance sheet risk, while the optimistic sell-side consensus is weighting future rent commencement heavily, assuming it all arrives on schedule. In this forensic audit, we do not price in future upside until the lease actually starts paying cash. The unit price sits at $0.505 against an adjusted NAV of $0.77 once distributable income is excluded. The discount to net asset value is heavy at 36.1%. The discount to the InvestingPro fair value is much tighter at 9.8%. That tighter margin aligns with the reality of a trust that is managing operational headwinds and balance sheet constraints simultaneously. The market is not giving this REIT full credit for its future development, specifically the major refurbishment project. Management highlights a 35% net rent increase on the Linton Hall Road refurbishment. That is a genuine operational win. But the pro forma annual rent of $18.08 million does not commence until December 2026. Until then, the market is pricing in the holding cost and the vacancy drag on that asset, not the eventual upside. Think of it the way you would think about buying a resale flat mid-renovation. The eventual layout and rent look better, but you are servicing the loan every single month while that particular unit sits completely empty. Northern Virginia is Digital Core REIT's largest single metro exposure, making up 33% of the portfolio. Right now, it is the center of an unresolved fight over the state data center tax exemption, which is valued at roughly $1.6 to $1.9 billion in foregone state revenue. The state legislature adjourned a special session in April without an agreement. This is not a problem specific to Digital Core REIT. It touches every operator there. But because a full third of this portfolio sits in that state, it is a genuine forward risk that we need to monitor. My stress test floor stays at 3.2%, regardless of where short-term rates sit today. The 6-month Singapore T-bill cleared at 1.55%, and I do not lower my own bar just because the risk-free alternative is soft this quarter. The minimum yield hurdle stays firm at 4.7%, which is the 3.2% floor plus 150 basis points of equity risk premium. Digital Core REIT is delivering an annualized distribution yield of 7.19%. That creates a spread of 5.64% over the T-bill. It beats our forensic floor by 3.99%, and it comfortably clears our strict minimum hurdle by 2.49%. The distribution clears all 3 yield tests with plenty of room to spare. This is the part of the report that genuinely deserves the strong half framing, but as we know, the balance sheet is a completely different question. The annualized yield has improved by 34 basis points to 7.19%, which is a clear pass. The DPU held flat at 1.80 US cents, also a pass, but the NPI margin dropped by 280 basis points to 49.3%. Organic cash NPI fell by 7.1%, and the adjustment ratio jumped by 10.1 percentage points to 58.5%. The income is passing the yield test, but the operational engines generating that income are flashing red across the board. Aggregate leverage rose to 39.2%, which fails our 35% ceiling. Total debt outstanding climbed to $715.89 million. Interest coverage dropped to 3.2 times, which fails our 4.0 times floor. Fixed rate debt sits at 70%, failing the 80% standard. The only passing metric here is the debt maturity profile, with the nearest maturity pushed out to December 2027. Aggregate leverage hit 39.2%, which is a 4.2 percentage point breach above the 35% ceiling. Interest coverage sits at 3.2 times, which is a 0.8 times shortfall below the 4.0 times floor. Both gates fail independently, and they are failing at the exact same time, a materially different picture from a single narrow miss. And on top of that, the company funded part of its 8 million unit buyback with debt at an average price of $0.488 per unit, which lifted total debt outstanding while gearing was already trending the wrong way. If borrowing costs rise by 100 basis points across all facilities, it would add roughly $7.16 million in annual interest expense. That moves the interest coverage ratio from 3.2 times down to 2.5 times. That single move would cut annual distributable income by close to 30% for a retail investor holding 50,000 Singapore dollars in SRS funds invested here. That interest rate shock would take the effective net yield from roughly 7.1% down toward the high 4% range, uncomfortably close to the absolute hurdle itself. Not everyone wants to read balance sheets for fun. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access for 12 Singapore dollars a month, less than 2 kopi and kaya toast sets at Raffles Place. The link is in the description. The path ahead here depends heavily on factors outside management's direct control. Let us look at exactly how this could play out over the next year or so. The path forward hinges on two things resolving in the REIT's favor: US rate trajectories and the Linton Hall lease commencing on schedule in December 2026. In a bear case, where rates stay elevated and the lease is delayed, refinancing costs rise, NPI drops, and the yield compresses toward the hurdle. In the base case, where the lease commences on time and rates hold flat, organic NPI recovers, leverage stabilizes, and the DPU holds near its current level. In the bull case, where rates ease and gearing is brought below 35%, interest coverage recovers and both the DPU and yield improve. A 35% net rent increase at Linton Hall is a genuine result, and it is the kind of operational execution this sponsor is built to deliver. But financing a unit buyback with borrowed money, at the same moment interest coverage sits at 3.2 times, spends balance sheet flexibility to defend a DPU metric that was never actually threatened. Good property management and disciplined capital management are two completely different skills, and this half showed only one of them clearly. Digital Core REIT sits in Zone 4. Caution, negative suffix. The trigger is aggregate leverage and interest coverage failing together, not asset quality, since this remains a high-quality, mission-critical data center portfolio. For anyone drawing income from this trust today, that combination means real caution is warranted right now. The negative suffix reflects two independent hard gate failures landing at the exact same time. Aggregate leverage sits at 39.2%, a 4.2 percentage point breach that independently qualifies for Zone 4 on its own. Interest coverage sits at 3.2 times, a 0.8 times shortfall against the 4.0 times floor. Either failure alone would put this at a standard Zone 4. Both failing together is what earns the wider suffix. This is not a permanent read on the business. A reader with a genuinely longer runway before drawing down retirement income can reasonably hold through a balance sheet repair story like this one. Capital that sits beyond what you need for near-term income can tolerate this kind of leverage while the Linton Hall lease ramps up and management works gearing back under 35%. But that story has to be visible in the numbers, not just promised on paper. This is describing how the framework is calibrated. It is not a suggestion that any particular reader fits one bucket or the other. For a reader in the drawdown phase, actually spending distributions from this REIT today, the calculus is very different. Almost 60% of this half's payout came from non-cash adjustments, not rent. Both balance sheet gates are failing at once, heading into a rate environment that has not fully cleared. That combination deserves real caution, regardless of how comfortably the yield itself clears every hurdle. The distribution passes every income test I hold it to, but the balance sheet behind it does not on two separate counts at the same time. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The window is already open. Get the full report the moment it is ready, not a week later when it is old news. The link is in the description. Are you holding this unit for its underlying property cash flow, or because non-cash accounting adjustments are maintaining the headline payout? This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.